17 years ago, the global financial system came within hours of collapse. The 2008 crisis, born in the mortgage markets, spread through Wall Street, and detonated across the world, changed everything. But here's the part most traders don't realize. It never truly ended. Because the decisions made in 2008 still echo through every currency pair you trade today. Every chart, every rate hike, every risk move, they're all haunted by 2008. This isn't just history. It's the blueprint of the modern Forex market. Let's go back to the moment the system broke. Lehman Brothers had just fallen. The interbank market froze. Credit vanished overnight. Global trade stopped. And the world's financial system was suddenly starved, not of money, but of dollars. The world didn't need liquidity in general. It needed US dollar liquidity. Because the dollar wasn't just America's currency anymore. It was the global funding mechanism, the backbone of global finance. When that dollar supply dried up, every major economy panicked. Central banks had to open swap lines with the Federal Reserve just to keep their banks alive. And in that moment, a new financial world was born, one where the dollar ruled not by politics, but by plumbing. That's the origin of today's Forex market structure. A system built on trust in the Fed, dependence on swap lines, and fear of liquidity withdrawal. Fast forward to 2025, and those same mechanisms still define everything. When you see euro to US dollar fall after a Fed statement, when US dollar to Japanese yen surges on a yield move, when emerging market currencies crumble after dollar strength, you're not watching new dynamics. You're watching the aftershock of 2008. Because every global institution learned one truth back then: when crisis hits, there is only one safe asset: dollars. That lesson became the foundation of post-crisis Forex behavior. Let's break it down. First, 2008 created the risk-on/risk-off cycle that dominates Forex to this day. Before the crisis, markets reacted to fundamentals: GDP, inflation, trade data. After 2008, everything became binary: risk-on or risk-off. If investors felt confident, they dumped dollars and bought high-yield currencies. If fear rose, they rushed back into dollars and yen. That reflex, that fear muscle memory, still controls global capital flows. Second, 2008 created permanent structural dollar demand. Foreign banks, corporations, and governments learned they needed dollar reserves, not for trade, but for survival. That's why the dollar keeps rising in every crisis, even when the US is the cause. It's not strength. It's shortage. Third, 2008 reshaped central bank behavior. After the crisis, the Federal Reserve became the de facto central bank of the world. Every global downturn since then, from 2011 to COVID to the 2022 tightening shock, has forced the Fed to reopen swap lines. These swap lines are invisible highways of liquidity, connecting Washington to London, Tokyo, Frankfurt, and beyond. They ensure that no matter where a crisis starts, it ends in dollars. So when traders today analyze central banks, they're not just watching policy. They're watching plumbing. Fourth, 2008 changed how risk is priced. Before the crisis, interest rate differentials drove Forex. After it, liquidity premia, the availability of credit, became king. That's why in 2025, you can see currencies move violently without major data surprises. Because modern Forex isn't about economics, it's about liquidity psychology. And fifth, 2008 permanently rewired investor psychology. Fear of systemic collapse never left. It lives inside every portfolio manager who survived that decade. It's why the market still overreacts to small shocks. Why safe haven demand spikes at the first sign of volatility. And why the dollar, despite debt, deficits, and politics, still dominates every crisis cycle. You can see it everywhere. Look at the yen in 2025. Still a refuge when markets panic, still tied to carry trades that unwind at the first whiff of fear. Look at the euro, still dependent on dollar funding to support its banks. Look at emerging markets, still crushed by dollar strength whenever US yields rise. It's all the same playbook, because 2008 rewrote the rules forever. The shadow banking system that caused the collapse never disappeared. It just moved offshore, rebranded as market-based finance. And every time the Fed tightens, that system trembles. The leverage might look smaller now, the instrument's more sophisticated, but the dependency is deeper than ever. Even crypto, the supposed alternative, was born out of 2008's mistrust in banks. But ironically, its price still tracks liquidity cycles created by those same central banks. When the dollar strengthens, Bitcoin falls. When liquidity returns, it rises. The ghosts of 2008 haunt even decentralized finance. And here's the paradox. Every attempt to fix the system since 2008 QE, repo facilities, swap lines, rate hikes, has made the world even more addicted to dollar liquidity. The world needs the dollar. The dollar needs the Fed. And the Fed needs to avoid breaking the system it built. That's why every major Forex move in 2025 still follows the same rhythm. Dollar up when fear rises. Dollar down when liquidity floods back. Risk assets dancing in sync with global dollar flows. The names change. The instruments evolve. But the architecture remains the same. Because the 2008 crisis didn't end. It was simply institutionalized. It became the operating system of global finance. And Forex traders, whether they know it or not, are still trading that same script. So the next time you see a sudden move in the dollar, or a yen spike out of nowhere, or emerging currencies collapsing without warning, remember this isn't new. It's the same earthquake still sending aftershocks through the global economy. The 2008 crisis didn't just move the markets. It became the market. If you found this breakdown insightful, make sure to like, comment, share this video with a trader who remembers 2008, and subscribe for more cinematic deep dives into the forces still shaping global finance today.